Let's get a quick check of the markets right now. You can see right now a bit of a mixed action. We're looking at the markets. The Dow pulling back more than 200 points, down about 0.5%. The S&P down fractionally, on pace to perhaps break that 7-day win streak. The Nasdaq, though, still on pace, up about 0.25%. The Russell, the small caps, pulling back about 1/3%. Jim Lebenthal, you're right here to my left. I'm going to start with you. A lot of talk about maybe we've already seen the bottom in this market, despite the fact that it's only a 2-week ceasefire and there's a lot of geopolitical questions out there for the markets. Are you viewing this 7-day win streak for the S&P, again, under some jeopardy right now because we're fractionally lower? Do you see this as a sign that we've already seen the bottom in the markets? They'll at least have steadier ground going forward.
Well, the correlation between whether we've seen the bottom or not ties to whether we've seen the peak in hostilities. And this week, the belief is, after Tuesday, that we have seen the peak in hostilities. But there is still doubt, and those doubts are understandable with the Strait of Hormuz still closed. Last I saw, something like a dozen ships have transited in the last day or so, which is not a lot. And with Iran extracting tolls, that's eventually going to get, I think, enough under the president's skin that he's liable to pick up hostilities again. Now, that doesn't mean we have to go back to the bottom of a couple of weeks ago. As long as we're not putting out their rhetoric about ending civilization and things like that, then the bottom is in. So I'm not, the problem with the question is nobody really knows, Frank, right? There's just no way to know if the end of hostilities, or rather the peak of hostilities, is in place. If it is, the bottom's in. Now, we can expect volatility, and there will be, flare-ups, Lebanon, Karg Island, whatever. But if we've seen the peak, then we are going higher through the rest of the year.
So, Brent, I want to bring that same question over to you. Also, I want to add to it. Have we perhaps seen too much of a rally over these last 7 days? Again, the S&P pulling back a bit, but the Nasdaq on pace for 8 days of gains.
Yeah, well, I think that we think the bottom's in. I think from a technical perspective, we're about 140 points above, S&P points above the 200-day moving average. That is a very positive sign because nothing good happens below the 200-day. So what was resistance is now firmly support. And I actually think the market setup is quite constructive going into earnings. And so obviously we'll talk about banks later. But I think the mega cap tech earnings, especially like the Microsofts and Googles, will be very strong. And so I think we actually have a good setup. And so as long as we're above that 200-day, which we firmly are, I think that puts a really good setup. And obviously also yields, I think, have calmed down. And so to me, those two things, yields and above the 200-day going into earnings, I think portends good things to the market over the short term.
Yeah, to your point, by the way, the early reporters, very strong showing, only 4% of the S&P, but again, a strong showing. Let's talk about that setup for a bit. Bill, I'm going to come over to you. BTIG's Jonathan Krinsky out with a note saying the S&P's up for its 7th consecutive day. This has happened 31 times since 2003. A pause or pullback on Friday wouldn't be surprising. We may be seeing that right now, but he goes on to say 20-day returns are quite positive following these streaks. So is this a really positive setup despite the action today?
Yeah, I think it's very positive. I've been fairly bullish over the past week since that low on Monday. I think there's been definitely a transition, how the pulse of the market in general. We heard from Powell last Monday that they're not going to look to be hiking rates on an energy shock. I think the market really liked that. From a fundamental basis, the S&P was trading at 19 times earnings, so that's below its long run average. I think too, you got to look at some of the panic that did take place. Now, it was an extreme panic, but the VIX did get to 30, and I think that's a helps to bring a bit of a turning point. So I think the pulse of the market, even as the news flow some days it deteriorated, the market was still able to kind of move higher. I think it's looking at incrementally improvement from where it was over the last weekend or where it was 2 weekends ago. But the market itself does know on Friday what question marks can happen over the weekend, and that the weekend has been where some deterioration and whether it be ceasefire talks or progress has happened. So I wouldn't be surprised to see a little bit of profit taking here. I remain very bullish at this level. I'm watching most closely. The S&P June futures have the highest 200-day moving average. It's just the way this is constructed. It's right around 6,800. I don't want to see it close below there today. It's about 1% away, let's call it. So I don't want to see anything bad happen. Before the end of the day, that would be difficult. But to play devil's advocate, I think, you look at everything the market has digested, the earnings that are coming, the bar is beginning to be set pretty high. It's becoming to be that this is going to be the savior and the market's going to run away. And so to play devil's advocate, I think we can, we may not really go anywhere given that it's the second year of a presidential cycle with the midterms coming down the pipeline. I think that we could see this continue to higher, but I'm not going to get overly bullish that we're going to break out record highs and keep going.
But you're taking both sides of the argument, by the way. You made an argument that you played the devil's advocate on your own. So
there's a lot of uncertainty.
There is certainly a lot of uncertainty. So I'm giving you some grace, but you said there might be some profit taking. Would you take some profit today? Are you thinking there might be more volatility after today?
Well, from a trading perspective, I trade futures. We've trimmed a little bit on this run up of what we've had in our portfolio on the futures side. We haven't looked to be trimming wealth portfolios and the active managed securities portfolios at this level. I think we can continue to go higher. From the way I'm looking at it is short term. If your timeline is shorter, yeah, it's good to be taking some chips off the table. If your timeline is longer, I think the run here still has legs, and you want to look for some sort of deterioration or confirmation that we roll back over before you start to panic again. But again, with that said, I'm just saying the bar is getting to be set pretty high for what the earnings to come are, and that does worry me. But it also just kind of defines that the second year of a presidential cycle, we may not really go anywhere until the end of the year, and we could see this run go up to 7,100, 7,200, but not really continue to extend from there. So I want the expectations to be tapered.
All right. Before Bill played devil's advocate, he hit on something else. Bond yields in the 10-year about 4.3, the VIX at about 20. He seemed to think it was pretty benign. Do you agree with that? Is the setup pretty good going forward if we can keep things at this level with both the VIX and yields?
Yeah, and I think your caveat is the linchpin of the whole story, because even at 30, the VIX hadn't capitulated too much. We saw a massive sell-off, and thankfully there's been a tremendous relief rally this week. And I think the important part, Frank, is that there was an emotional shift. Like, you can almost feel it. The things were so bad potentially, like the worst possible geopolitical outcome that could have happened. Removing that from the table, no matter what happens over the weekend, and we'll certainly see headlines about the ceasefire. Ceasefires early on are typically fraught with some problems and challenges, but I would say the setup's pretty good. And the reason that yields are down, Frank, has a lot to do with oil. Take the pressure off oil, take the pressure off interest rates. That also helps with inflation, which again continues to be the thing that I'm focused on most. I think earnings are going to be great. We have to look at the guidance. I think that's going to be a lot more important this quarter than perhaps it has been, but they're going to be excellent, and I can't wait to get talking about actual earnings.
So Scott, yesterday, he talked to Michael Hartnett from BofA. He kind of said the pre-war playbook is back on. He went on to say a couple other things. Trader sentiment was sell the rip now, new highs by May. Bulls in charge as long as semis, biotech, and commodities hold high, but bears back in charge if bond yields fall and high-yield bonds and private credit still can't catch a bid. Jim, coming back over to you. Agree with that sentiment right there? If those areas continue to move higher, that's a sign that we're still in a bull market?
Yeah, but let's put an asterisk to this. I don't think we're going back to the way we were in early February anytime soon.
What do you mean in particular?
In particular, oil, which does tie into sentiment, which then does tie into the markets. There's just no way we're going back to $60, $50 a barrel oil anytime soon. And I hope I'm wrong. I hope I'm jinxing it. And, next week we're at 40, but that's just not going to happen. The Strait of Hormuz is closed. All those production facilities are going to take a long time to restart. So this is going to be with us for a while. Having said that, there is reason to think that the cushions that we entered this year with, Frank, in the economy and the markets are still in place. What am I talking about? I'm talking about things like the stimulus from the budget bill, which is flowing through to capital expenditures here in the United States, on top of artificial intelligence build-out. Oh, and stability in the labor market. I mean, has anybody looked at initial weekly jobless claims recently? Extraordinarily low. Continuing claims coming down as well. Now, we've eaten into some of those cushions. Like, for instance, I don't think we're going to get a rate cut this year. And so maybe that, should temper our expectations going forward. But when I say temper our expectations, we should expect that by the end of this year, we are nicely above the all-time high in the stock market. We should also expect a lot of volatility between here and then, again, because who knows what's going to happen over the weekend in the Gulf? Who knows what's going to happen Monday, Tuesday, Wednesday, particularly if Iran continues to charge tolls for tankers going through the Strait of Hormuz.
So I want to ask you about one other thing, inflation. So you're mentioning oil is a big part of this story. We saw CPI today. It just kind of showed that when we're looking at headline inflation, it's kind of sticky. Energy prices certainly spiked. A lot of people think the next two reports are going to show an even bigger spike. But when you look at core, that was actually pretty reasonable. The direction seeming to be pretty good. So are you saying inflation doesn't matter as much going forward because the Fed's told us the oil shock's not going to, lead them to hike rates?
Inflation is keeping them from cutting rates. Now, I don't think.
But they're also not hiking.
Well, let's parse that a little bit, because in the Fed minutes that were released this week, there was more chatter about rate hikes. Now, I strongly believe that would be foolish of the Fed to raise rates. That's not going to create more oil flow through the Strait of Hormuz. It's just going to damage jobs. However, history has shown and market experience shows that, sometimes the Fed does things that it shouldn't. I mean, ever heard of the Fed making a mistake? I hope they don't make this mistake. Frankly, it would be catastrophic.
Well, if you look at the inflation report today, there are components within core services and components within core goods that are showing a drop. There are some actually really good bright spots here. But you take a look back at the February PCE number that came out earlier in the week. I think that was it 2 days ago or yesterday morning. That number, the personal income data, contracted surprisingly. And then you get some of the spending and the goods inflation numbers here in this March number comes down. And then you see the sentiment data in Michigan today comes down. So, you're not really seeing a reaction in the Treasury market to some of this negative data, even though, the expectations of CPI were fairly high for the headline number, but it still came in below those expectations. I'm wondering why we're not seeing more of a reaction in the Treasury curve. And if you look back to December right now, there's 25% chance in December that the Fed will hike rates only 25 basis points this year. So through the end of the year. I think that is mispriced. But my question, kind of again, that devil's advocate story is, what creates that cutting? Sorry, it's a 25 basis point cut. What creates that story for a cut? Does it start to see further deterioration in the consumer? And then what does that do to the market? So I think there's a lot of questions here. Right now, the tailwinds are strong for the price action. But again, I think you have to, at these upper levels, as we close in on the record highs, you have to have some questions you got to pose to yourself.
Bill, to your point, we've seen the market react very strongly to a few data points in an economic report like a CPI. Brent, I want to come over to you. Surprised we're not seeing a bigger reaction. Gasoline prices up 19%, electric up but just about 4.5%, just a tick over that, and then piped-in gas service up over 6% as well. And a lot of people believe, if you look at any economist note, this is just the tip of the iceberg when it comes to the impact that we're going to see.
I think so. The market has obviously digested this. I think right now, I agree with Jim, by the way, that I don't even see remotely how oil has a 6 or 7 handle on it. And so, but I think the market is taking this, very well. To me, where I look at inflation is the rig count has not moved since pre-Iran war. On top of that, I want to say 90% of all manufactured products, just think about plastics, et cetera, all have oil, energy, hydrocarbons as an input inside of that. And so prices over time are just going to go higher. And so I do think these inflationary numbers are going to get sticky just because oil is in everything. But I think that Kevin Warsh, whether he comes in May, July, or October, however that happens, I still think we're going to get a rate cut. Whether we should get one or not, I think that the market feels like that's going to happen. And so I think the balance of the two is why the market is digesting that. But ultimately, if we have earnings growth, if we have productivity, right, productivity starts to show itself. To Jim's point, unemployment stays low. The market will look through this for the time being. And so that's why I still think I'm quite constructive, especially technically, with the earnings growth and what the market has digested, and also with yields, I think, being very anchored here around 4.25 to 4.40.